In this free small trading course, I'm going to tell you what you wish you had learned in the first time you heard about trading. The ideas I'm going to expose here are valid for both beginners and advanced traders. As many of you know, trading is one of those domains where you have to learn hundreds of small lessons in order to tune your behavior towards success. In the small course, I'm not going to cover all of these small lessons obviously, but I'm going to attack the major lessons and perhaps some ideas that you never heard of, and that might explain certain behaviors that you act out without knowing why you act out. The first thing that comes to mind is that people are confused about the goal of trading. They believe that the ultimate goal of trading is to make money, but that's not exactly true. The goal of trading is to make money consistently in the long term, which is quite different than making money sporadically in the short term. Those two things are not the same thing even a little bit. That seems obvious, but traders still don't act it out. For some reason, most traders have difficulty thinking in terms of the short and long terms. Traders don't enter the market with the idea of making money in the short term and then getting out of the market. Everybody that enters the market has this idea of sustaining profits for years to come, and yet they act like they are going to leave the market next week. This situation puts traders in the wrong mode of behavior, where they only think about what's happening today. If you want to make money consistently in the long term in the financial markets, you have to act in a way that allows you to trade profitably and safely today, tomorrow, next week, next month, next year, and in the next decades possibly. In other words, you have to act today based on the fact that you want to keep trading for a long time without breaking your account and being catapulted back to the starting position. That's not easy, of course, and there is a specific mode of behaving in the markets that allows a trader to achieve this long-term sustainability I'm talking about. However, there are some pernicious problems that occur in trading that might confuse the minds of traders when it comes to this counterpoint between the short-term success and the long-term success. For example, when traders experience success in the short term, which is something very easy to do by the way, they start to believe that what they are doing and the way they are trading is in fact correct. That is precisely where these traders go wrong. Just because you made some money in the short term doesn't mean that your mode of trading is capable of sustaining you in the long term. It's very possible that the way you act is supposed to make you successful in the short term and fail in the long term. But the problem is that you might know why that happens. At this point, you might think that this can be just my opinion, so I would like to provide some hard science to show you that things are not so simple as they seem to be sometimes, especially when we are talking about trading. To understand why the situation between short-term and long-term success happens in trading, we have to learn a concept in statistics called the law of large numbers. You can understand this idea intuitively by performing a coin toss experiment. Just bear with me for a moment here, and you'll see what I mean and how this is related to trading in a big way. Imagine in the first moment that we will perform 5 coin tosses in a row. Everybody knows that the probability of getting heads is the same probability of getting tails. It's 50% for each side. It's 50% because there are only 2 possible outcomes in a coin toss, and they are equally likely to happen. This is called the theoretical probability of getting heads or tails. If we perform 5 coin tosses in a row, we might get a result like this. We might get, for example, 3 heads and 2 tails. When we deal with the act of flipping the coins, we are dealing with the experimental probability, and notice that something is not right here. Out of the 5 coin tosses, 3 were heads and 2 were tails. According to the experiment, there is a 60% chance of getting heads and 40% of getting tails, but we know that the theoretical probability of getting heads or tails is 50%. This discrepancy is emerging because of the size of our sample, meaning how many times we are performing the coin toss, and that's what the law of large numbers is all about. The law of large numbers states that the experimental probability converges to the theoretical probability as the sample size grows. In other words, if we perform 100 coin tosses, we'll observe that the experimental probability will be very close to the theoretical probability because the sample size is much larger now. This is exactly what happens in trading. Instead of coin tosses, imagine that your trades have a theoretical probability of winning. Notice that the experimental probability you get in the short term is different than the experimental probability that emerges in the long term. The result is that even a bad trading system or strategy can generate good profits in the short term, but never in the long term. In trading, it's actually more complicated than that because we can't know for sure what the theoretical probability of each trade is because there are many variables that alter that probability in real time. Even so, the lesson you should take away from this is that things behave differently depending on the time horizon you analyze them. In other words, just because something is working in the short term doesn't mean it will work in the long term. In fact, there are modes of trading that are likely to cause profits in the short term and guaranteed to cause margin calls in the long term. If you act this out, you will keep trapped in this vicious circle for a long time without really understanding what's going on. All of that begs the question of what is the correct mode of behavior for producing consistently profitable results in the long term. The answer to this question is threefold. Part of this answer is already a cliché, but there is another part of the answer that nobody talks about, and it's equally important. To create a mode of trading behavior that will sustain you in the long term, you need a combination of technical precision, risk management, and trading psychology. But you probably already know that since the cliché by now. The not so obvious part of this answer is that all of these three elements are deeply intertwined, and if you get one of them wrong, the whole thing falls apart. Let's begin first by talking about risk management. If you want to survive and maybe thrive in the long term, you need to expect to win more than what you expect to lose, and you need to act that out in every trade. That means, of course, maintaining a good risk-reward ratio in every single trade that you make. That's going to make an enormous difference in the long term. For example, if you have a 1-to-3 risk-reward ratio, in the long term, you can expect to win $3 for every dollar that you risk. That seems perfectly reasonable, but there are a few problems here. If maintaining a good risk-reward ratio will allow me to win more than what I lose in the long term, I can simply open trades randomly with a good risk-reward ratio, right? Wrong. If you open a series of random trades with a good risk-reward ratio, you will learn that you will break even in the long term. The reason for that is something called trade location, which relates to how close a trader can get to the reversal points of the market. If you open trades randomly, many trades will be opened far away from the reversal points of the market, and many will be placed near the reversal points as well. In the long term, these things will cancel each other out and you will break even, which is better than losing money, but is still not optimal, of course. That brings us to the technical aspect of trading. Let's imagine, for simplicity's sake, that there is a correct stop-loss level and a correct take-profit level, and the only variable is the entry point of your trade. If you are not a precise trader, your inability to enter the market near the reversal point will increase your stop-loss size at the same time that it decreases your take-profit size, which is a lose-lose situation, which will of course hinder your risk-reward ratio, and we already saw how that's going to hurt your equity curve in the long term. However, if you are a precise trader and you can enter the market near the reversal points, you decrease your stop-loss size at the same time that you increase your take-profit, so it's a win-win situation. That leads us to the next interesting way in which trade precision is tightly correlated with risk management and trading psychology. If you have the ability to be precise, you can maintain short stop losses and large take profit targets. That also means that you can make money even if you are wrong most of the times, because it takes many stop losses to wipe out one take profit. The way this is related to trading psychology is that the fact that you can make money consistently even when you are wrong most of the times gives you incredible peace of mind. Trading psychology is like a road intersection of bad emotions, and each of these roads is a slippery slope. The thing about slippery slopes is that you only stop when you hit the bottom, no matter what you do. All the effort of trading psychology is to avoid waking up the irrational part of the human psyche that is very poorly behaved and doesn't know how to handle emotions intelligently. The more you amplify your emotions in trading, the more likely you are to wake this irrational part of yourself. There are mainly two things that amplify your emotions in trading: the pressure to be correct all the time and the amount of risk you take in your trades. If you respect the risk-reward structure that I'm promoting here, and you become a precise trader, you will eliminate this pressure of having to be correct all the time. The other part of that equation is knowing how much to risk. If your emotions get too pronounced or you notice them emerging all the time, you are risking too much. There might be a number of reasons why you risk more than what you should, but for the most part, traders do that when they want to make money quickly, and that's its own little rabbit hole that we can exploit. First of all, when you risk too much, you dramatically increase the chances of waking up the irrational part of your personality, which by itself will lead you to one or many of the psychological slippery slopes that exist in trading. Once that happens, it's game over for you and your equity curve. There's a limit to how fast you can grow an account, just like there is a limit to anything else in life. For example, if you want to become a professional piano player, there is a limit to how fast you can develop the techniques and knowledge about music theory. You are not going to become a professional piano player in one day, nor 1 week, 1 month, or 1 year. There is a biological limit to how much you can develop yourself, no matter how many hours of work you put in, or how bad you want to succeed. When you risk too much of your capital because you think you are smarter than everybody else, and you will cut corners in the market, all you are doing is try to bend the structure of reality because of your unwillingness to sacrifice yourself to grow a solid equity curve in the long term. You can be sure that every time you try to change the way reality works, it will snap back at you and run you over like a juggernaut. Ironically, trying to cut corners in the market by risking too much is actually the slowest way of making money, because it will keep getting catapulted back to the starting position over and over. So the lessons I want you to take away from trading psychology from this video is that you should eliminate the pressure of being right all the time by using the correct risk-reward framework, and you should not try to cut corners in the market by risking too much, because that will guarantee that you wake up the irrational part of your personality, and that by itself will put you on a dangerous path that never actually goes anywhere. Needless to say, there are literally hundreds of other small lessons about technical precision, risk management, and trading psychology, so this video is merely an introduction. The key things I want you to remember is that things behave differently in the short and long terms. The three most important aspects of trading, which are technical precision, risk management, and trading psychology, are all intertwined. In order to expect winning more than losing in the long term, you have to use good risk-reward ratio like 1:3, for example. However, for that to work, you need to be able to be precise in your entries, which means getting near or at the reversal points of the market. At the same time, you need to eliminate the psychological pressure of being correct all the time, which is also done by using good risk-reward ratios. And you need to avoid the temptation of cutting corners in the markets, because it will certainly backfire at you. Obviously, there's a whole lot to be said about technical precision, risk management, and trading psychology, and I intend to explore each and every one of these small lessons in future videos, but I guess this one serves as a good introduction. I hope you learned something new and useful with this video. If you want to learn how to trade with professional techniques, please check out the video courses that I provide. For beginner to intermediate traders, I offer the Fractal Flow series, which is composed by the Fractal Flow strategy, the Market Maker strategy, and the Newtonian trading strategy. Each one of these will teach you a different approach to trading. Each of these strategies work on their own, but they can be combined together also. They work on any market and in any time frame that you wish to trade. For intermediate to advanced traders, I offer the Price Action series, which is composed by the heavyweight techniques involving fractal geometry, linear algebra, and very refined contextual market reading to find the most accurate trade entries and exits that are possible to find on a price chart. You can visit my website fractalflowpro.com to see more details about the table of contents of each course and the testimonials from students. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Don't forget also to check the other videos in the channel. Thank you very much for watching, and I hope to see you in the next videos. Take care.